I think you have to work with this hypothesis. That you...
Okay, that's good to know.
So let's give it 30 more seconds and then we can start. Okay, we just let the last person joining. So good evening, good afternoon, or good morning, whenever you are on the globe. It's my great pleasure to welcome you to this first virtual panel that we organize with EAXIS together with the Council on Economic Policies. In the previous seminar this year, we've reviewed a few proposals for central banks to align their policy with a transition to a low carbon economy. And then we have discussed also all this issue in depth last year in classical webinars. Today, we would like to change a bit the format and move to a panel to gather more views on the different proposals that are on the table now, that are discussed, and also the challenges for monetary policy regarding climate change. So one reason why we are focused on policy proposals with our seminar series this year is that the ECB is currently conducting a strategy review, which includes climate change. And in this context, Christine Lagarde has promised that the ECB will, and I'm quoting her, explore every avenue available in order to combat climate change. So today we thought it would be a good idea to discuss a bit these avenues and the context in which they are. And we will do that with a panel of highly qualified practitioners, try to put all this proposition in perspective with what is central banking. So for this, it is my pleasure to welcome our three panelists for tonight. All of them are currently working for major central banks in the Eurozone, and then thus are directly concerned with these propositions. They will give us an overview of what central banks and financial regulators can and must do to align policy on environmental sustainability. But they will also tell us what central banks cannot do, and basically what are the most promising avenues to associate with central banking and environmental sustainability. So let me introduce you our panel tonight. Let me first introduce Katrin Assenmacher. Katrin is the head of the Monetary Policy Strategy Division at the European Central Banks. She has been there since 5 years now. And she, I think, has a unique point of view to discuss the links between climate change and ECB strategy for its monetary policy. Just before joining the ECB, Katrin has led the monetary policy analysis at the Swiss National Bank, where I had the pleasure to work with her for a short time. She is also an assistant professor at the university. She was assistant professor at the University of Bonn, and she has published several articles in international academic journals on modeling the role of Mönch. Katrin will be joined in this panel by Maria Nieto. Maria is a senior advisor at the Bank of Spain. She brings us a point of view of a specialist in financial stability and prudential regulation. She also represents the Bank of Spain at the macroprudential work stream in the NGFS, and thus she is well aware of the links between climate change and financial stability, as well as what central banks and financial supervisors can and cannot do about it. Maria worked with the International Monetary Fund, the Federal Reserve Bank of Atlanta, the ECB, as well as the Council of Economic Advisors for the Spanish president. Welcome, Maya, too. And finally, we are delighted to count Emanuel Mönch with us. Emanuel is the head of research at the Deutsche Bundesbank, and he is thus at the frontier of what we know about climate change and monetary policy. He is or was, I don't know, professor at the Goethe University Frankfurt. And by the end of this year, he will join the Frankfurt School of Finance and Management. Before joining the Bundesbank, Emanuel also worked for the Federal Reserve Bank of New York. And he has published on macroeconomic and finance in several top academic journals, such as the Journal of Finance, the Journal of Financial Economics, Review of Financial Studies, and Journal of Monetary Economics, for example. So welcome to you as well, Emanuel. We are all very eager to know your insightful views on monetary policy operation, financial regulation, and how they can better align with sustainable objectives. But before turning to you, I would like to first run a short poll with the audience on what central banks should and can do regarding regarding climate change. So if you could fill up these questions for a while, and then we will use them as a starter for the discussion. Let me also remind you that there is a Slack page associated to this seminar, where you can find the information about events and research, as well as interacting with researchers there, ask questions, and then maybe start a discussion there. So maybe we can see the result of the webinar. The first question: should central bank ask supervised institutions to better disclose climate-related risk, reduce the exposure of their own balance sheet to climate-related risk, or align their monetary policy operation with climate, or none of them? So what I think the first thing I see is to do none of the above is ruled out by almost everyone. And one of the things where everybody agrees is that they should ask supervised institutions to better disclose climate-related risk, but as well reduce their balance sheet and align their monetary policy. And for the specific, the second question, so which policy instruments should integrate climate consideration? There is a large consensus on prudential regulation, and also half of the people saying that collateral framework and asset purchases should integrate climate consideration. And again, doing nothing seems to be ruled out by everyone. So with that in mind, let me turn first to you, Katrin. And could you tell us a bit more what you think are the implications of climate change for monetary policy, and how it can influence the monetary policy stance of the ECB, for
example? Okay, thanks a lot for inviting me. So it's a pleasure to be here and to discuss with such a distinguished panel. So I'm really looking forward to the exchange tonight. And let me say upfront that the views I'm expressing are, of course, my own. So these are not the views of the ECB or of the Euro system, but this is something I think any central banker has to say when they participate in such an event. So climate change for now has been recognized as an important topic almost everywhere, and so also in central banks. And there is a broad-based consensus around the world that something has to be done, that carbon emissions have to be reduced to tackle global warming, and that global warming would potentially have catastrophic effects that need to be avoided. And there is a growing awareness among central bankers, and this is evidenced by increasing speeches. So Pierre, you mentioned some words by President Lagarde, who said that the ECB should look at all avenues, how it can contribute to avoiding climate change. There is an increasing research, so you can go to the ECB's website and you will find a number of discussion papers that are looking at climate change. You have presented some of them in your previous sessions at e-Access. And there are also initiatives in the central banking sphere. Let me just mention the Network for Greening the Financial System that is bringing central bankers and supervisors together to look at what can be done to foster climate change mitigation measures. Climate change considerations also form an integral part of the ECB's monetary policy strategy review. So there are various work streams, and thinking about climate change and the implications of climate change for monetary policy making and for the monetary policy operational frameworks is one of these work streams. And the ECB has also announced that it will set up a climate change center, which is a function that in the bank that's reporting to the president, and that will coordinate climate change research and climate change related work inside the ECB. So let me say also that I will talk here about monetary policy mainly. So I will not dwell into the actions that can be taken on the regulatory side. I assume that Maria will tackle that. There is a lot that can be done on that front, but I will leave that aside because that's not my area of expertise and not the area I'm mainly working on. So the first thing I would like to talk about is the ECB's mandate. So it's a legal issue, but this is of course setting the framework for the actions that the ECB can take. So the mandate of the ECB is set out in the Treaty on the Functioning of the European Union, and that's the Article 127, and it says very clearly the primary objective of the ECB and the Eurosystem shall be to maintain price stability. So this is very clear, and the primary objective is price stability. But in this article, it's also said, without prejudice to the objective of price stability, so meaning when price stability has been achieved, the Eurosystem shall support the general economic policies in the Union as laid down in Article 3. So now you wonder what the Article 3 of Treaty on the European Union is. And this Article 3 lists a number of secondary objectives. And one of them is the Union shall work for the sustainable development of Europe based on balanced economic growth, price stability, and then there comes a list of objectives. And now it's interesting, a high level of protection and improvement of the quality of the environment. So based on this article, you can argue that the Eurosystem has also to take into considerations issues that are related to climate change. And there is another sentence in the Article 127, which probably can give kind of a limit to the climate change activity. It said the Eurosystem shall act in accordance with the principle of an open market economy with free competition, favoring an efficient allocation of resources. So of course, I guess Emanuel might talk about that. If you do asset purchases, you have to respect an open market economy with free competition, which again gives kind of a framework and limits to what a central bank can do and what it cannot do. So going to the consequences from these legal bases for climate change policy of the Eurosystem, it's very clear that the Eurosystem needs to be aware of climate change issues. And it has to consider how its policies may affect climate change and how they may interact with this topic. So it's very clear also from this Article 11 of the Treaty of the Functioning of the European Union, there is said environmental protection requirement must be integrated into the definition and implementation of the Union's policies and activities. And this, of course, also reflects on the ECB. It needs also to think about how climate change may impact on the policy space. So if I have time later on, I can say a little bit more about that, meaning how these long-term trends that are triggered by climate change can probably limit the policy space of monetary policy, how it can affect the transmission of its policy, so how climate change consequences are impacting on the transmission mechanism, and how it will affect its balance sheet. In particular, how can climate change related risks lead to losses on the balance sheet? How will this affect collateral, the valuation of assets? However, the ECB cannot pursue active climate change policy on its own. This is beyond the mandate. Just to say very clearly, so climate change is a secondary objective, so the ECB has a supportive role, but a supportive role means that the ECB cannot just step in and say, oh, we are now doing climate change because we think this is an important thing. That would be mission creep. That would be extending the mandate. On that part, governments are in the lead. So governments are politically elected bodies, so a central bank is not. And governments have also more effective instruments than a central bank. So they can affect climate change through either regulation, by issuing requirements, what is allowed, what not, regulation in terms of pollution, in terms of emission. They can set taxes. So there's a lot of literature around showing that carbon taxes can be a very efficient means to limit carbon emissions. And if governments don't act, so a failure to act from the side of the government is not a justification for a central bank to step in and to say, now we are tilting our monetary operations to achieve climate change targets, because this is going beyond the supportive role that the treaty is giving to the central bank. So, and I think I probably stop here and hand back to Pierre.
Thank you very much, Katrin. So maybe let me turn now to Emanuel to rebound on that, and also to precise that the ECB is now reviewing the topic of climate change and what it means for monetary policy operation in its strategy review. And maybe you can tell us a bit what you think about what can central bank do to integrate climate change, if they should do that, and how they can do it.
Happy to do so. Thank you also from my end for the invitation. It's great to be here and to discuss this very intricate and multidimensional, multifaceted issue with you. Looking forward also to the discussion with the audience. Of course, also the usual disclaimer applies to me. Whatever I'm saying here does not represent the views of the Bundesbank or the Eurosystem. I think we all agree that climate change is of first order for the global economy. And so carbon neutrality, to achieve carbon neutrality by 2050, to be in line with the Paris Agreement requires an immense effort of structural change. And this effort will have to take place at a much faster speed than most economic transitions. I'm personally from East Germany. I've observed from very close a very fast economic transition. I can tell you it's quite disruptive. There's going to be winners and losers. And I think what we are witnessing now with regard to climate change is also an extremely fast economic transition that we have to manage. And policymakers, I personally think policymakers, business leaders, investors only slowly are coming to grips with the magnitude of this challenge. And that's also true for central banks. But I think we are catching up quickly on this issue. And Katrin already mentioned the Network for the Greening of the Financial System as one institution that basically brings together central banks and other regulators and to discuss and promote action on climate change. But also, as you mentioned, Pierre, the Eurosystem has made climate change and the potential implications of climate change for monetary policy a key element of its framework review. I have the honor to co-lead the work stream on climate change and monetary policy, along with two colleagues from the ECB and one colleague from the Banque de France. And together with a team of 50 to 60 economists from the Eurosystem, from across the Eurosystem, we have written a report that basically considers the importance and the relevance of climate change for monetary policy in all its facets. I think I can say and share with you that we as a team co-authoring this report and many policymakers in central banks agree that a lot more analytical work is needed to tackle, to understand the implications of climate change for monetary policy. And what we also can agree, I think, on is that current market prices of financial assets do not fully incorporate all the risks related to climate change. So one key issue of any action of central banks and regulators has to be to improve the information that we have on emissions footprints of economic activities. And that information is just very scarce. There is information, but we do not have the information I think we need to live up to this challenge properly. So an important element of, I think, all central banks' actions should be to promote disclosures of climate-related financial risks. And in fact, these disclosures are a prerequisite for us to assess climate-related risks and design potential mitigating measures to address these risks. So what could the Eurosystem do first and foremost or what should the Eurosystem probably do first and foremost is to work to enhance disclosures of climate-related risks of the assets on its balance sheet. And there's a recent precedent for this. The ECB recently announced that regarding climate change-related risks, there will be a common stance for sustainable and responsible investment principles for non-monetary policy portfolios. And so an ambitious timeline has been agreed regarding the promotion of disclosures and an understanding of the climate change related risks for non-monetary policy portfolios. And I think these this ambitious timeline could also serve as a template for the monetary policy related portfolios and the disclosure of the climate change related risks in these portfolios. Such a credible or strict disclosure requirements would also then, of course, foster the production of and collection of the information on on climate-related risk in financial assets. So the Eurosystem, by promoting disclosures, could take a catalytical role in the information production. I think this is something that many across the system agree is a useful starting point. What is important in this regard is that the disclosures by rating agencies or the information on climate embedded in credit ratings is not fully understood. So we have to, I think, understand better what climate-related information rating agencies include in their credit risk assessments, and also to the extent possible have a conversation with the rating agencies and with other regulators, such as ESMA, who are involved in these with credit rating agencies to put pressure where needed on rating agencies to embed climate-related risks in their credit risk assessments. We also, I think, then need to think about what can we do in terms of our internal credit assessments. There's a number of assets we have on our balance sheets that are not rated by credit rating agencies. So similarly, for these type of assets, we need to think about how can we incorporate climate-related risks into the assessment of the credit worthiness of these issuers or of the credit risks embedded in these assets. And so with more information, then we can think beyond and think about adjusting the counterparty framework that we use to in monetary policy refinancing operations. So that's another dimension where I think with better information, we can think about adjusting the counterparty framework. We can also think about stress testing the Eurosystem portfolios. After all these steps are potentially taken, I think only then a next step could be to adjust the eligibility or investment criteria for the purchase programs that we have. And most prominently here, the corporate sector purchase program is relevant, where the Eurosystem purchases assets issued by corporate firms, many of which engage in carbon intensive activities. And so regarding the purchase programs, there's a number of different options. First, I think we can enhance the due diligence that we already do on the issuers of assets with respect to the CSPP, and can improve on this due diligence to manage risks related to climate change. We can think about excluding certain issuers altogether, potentially, from purchase programs. We could think about tilting the portfolio allocations within these programs. But all of these considerations, we have to be very mindful of not compromising our ability to deliver on the price stability mandate, which is our primary responsibility, as Katrin has pointed out. And so in that regard, asset purchases will always have to be in line with the open market economy and with a free competition. And so we need to think about ways to operationalize this concept of an open market economy and free competition, and to make sure that our adjustments or possible adjustments to purchase programs do not interfere with these principles. And I'll leave it at that. Thank you.
Thank you very much, Emanuel. So a lot of avenues that I will probably come back on in the second round. But before that, climate change has also a huge impact on financial stability. That has been recognized by all central banks. Maria, you are a specialist in this field. So where do you see the connection between financial stability, prudential regulation, and climate change, and in particular, what consequences has climate change for prudential regulation?
Well, thank you, Pierre. Thank you to the organizers for this invitation to join Emanuel and Katrin. I'm delighted. Also, let me make the usual disclaimer. Whatever I say here, these are my views, not necessarily those of the Bank of Spain or the Eurosystem. Let me say, and I think it's in this panel already been said, that climate risks are not fully reflected on the risk profile of banks as counterparties for monetary policy. But central banks are best positioned to assess climate risk by virtue of their prudential supervision and financial stability capabilities. Indeed, all the economic literature that was supportive of the centralization of supervision in the central banks was precisely to deal with the problem of information asymmetry on the true financial condition of banks. And that true financial condition of banks includes also their climate financial risk. At present, there is a consensus, and it has already been said, that climate change impacts are systemic in nature. Impact and the channels of transmission are economic growth, financial stability, and social. Financial stability, hence, should consider climate financial risk. And at this stage, we need to ask two questions. First, what are the objectives of the policymaker when tackling climate financial risk, and what are the challenges that they are finding? And the second question is how to deal with financial stability risks that stem from climate change. On the objectives, let me refer to the European Commission 2018 Action Plan on Sustainable Finance. There are three objectives in this plan. The first one is reorienting capital flows towards sustainable investments in order to achieve sustainable inclusive growth. This is an economic policy objective. The other two objectives are managing financial risks stemming from climate change and resource depletion. And second is fostering transparency and long-termism in the financial and economic decisions. These two can be considered prudential and financial stability policy objectives. In my view, all these objectives face an important challenge, and it's the very nature of climate risk, which is very different from the typical financial risk that central banks are used to deal with. How is climate risk different? Well, it's characterized by nonlinearities and tipping points in the system's reaction to human activities. We could not reverse certain impacts of CO2, increases in CO2. By the path dependency in policy decisions, policy depends on how decision makers perceive climate risk. Past data on climate is not a good predictor of the future behavior of climate risk. Climate risk is subject to high uncertainty of when it's going to materialize and how it's going to materialize. And climate risk develops over very, very long-term horizons as compared to the typical time horizon that central bankers take into consideration in their policy making. Against this background, this makes particularly important the use of certain analytical tools. And particularly, let me highlight the importance of climate risk scenarios for both transition and physical risk. These scenarios are consistent with certain temperature objectives that could be aligned with the Paris Agreement or not, policy responses to reach these temperature objectives, the availability of technologies to remove CO2 from the atmosphere, and the time horizon. I think it's very important to differentiate climate scenarios from financial stability scenarios because they differ fundamentally both in nature and in usage. Financial stability are meant to capture plausible but low probability adverse scenarios, while climate scenarios represent the probable representations of future evolution profiles of greenhouse concentration and various adaptation and mitigation strategies. And in this regard, let me highlight the work of the Network for Greening the Financial System, precisely of my team, which is working on climate scenarios, both for transition and physical risk, in order to provide a common starting point to analyze climate risk to the economy and to the financial system. These climate scenarios are supported by climate models. In our case, these are integrated assessment models that are being developed by an academic consortium, and each scenario is supported by multiple models, so they can be used to provide a range of estimates. We have at this moment 3 scenarios. 2 of them deal with the transition risk, an orderly and a disorderly transition that is compatible with the Paris Agreement of commitment to the increases of temperature of no more than 2 centigrades. And the third one is the so-called hot house world. In this one, the physical risks are very high, and this scenario is not consistent with the Paris Agreement. Let me now turn to the second question, how to deal with financial risk stemming from climate financial risk. And the empirical evidence so far is quite unconcluding. Let me just mention that the recent report by the Network for Greening the Financial System doesn't find historical data that support clearly a differential in the risk profile of brown and green assets. There is some empirical evidence for mortgages to energy efficient homes. I've seen some papers that refer to the UK market that controlling for the income level and the location find that these mortgages do have lower probabilities of default. On the syndicated loan market, there is also an interesting paper by Stephen Ongina and others published in 2018 that they find that the risk is priced for firms that hold more fossil fuel reserves, particularly after the Paris Agreement. So said all of this, and as I said before, the European Union is committed to revise all the financial regulatory framework. The approach initially was gradual, as envisaged in 2018, by the new objectives of reaching the net zero emissions by 2050. They will need to scale up these efforts. And let me just conclude, say that not only the approach was initially envisaged as gradual, although as I just said, a scale up will be very much needed, but also the sequencing of the mandate that the European Commission gives to the regulators. First, let's understand well what means climate risk. What are the implications for banks and for supervisors, and whether they should be considered as part of the regular supervisory work. Second, let's design a disclosure, not only for climate, but also environmental, social, and governance, which is the broader objective of regulators in Europe. And last but not least, assess whether a dedicated prudential treatment for exposure associated to assets and activities with high environmental risk would be justified. Thank you.
Thank you very much, Maria. Let me push you a bit on what you just said to try to see how that can concretely lead to change in regulation, and then I will come back to the other panelists. So you really emphasize that climate risk is a systemic risk in nature, and so it's systemic, and like the NGFS is also clearly saying that climate risk are financial risk. So it's systemic financial risk, and I don't see, and for systemic financial risk, we have, or the community has developed tools like macroprudential buffers to deal with that. I don't see so much a big difference between climate risk and other systemic risks. I mean, climate risk are financial risks, so they will materialize in terms of financial flows. You also have, it has been said several times today, you also have a mispricing probably on the market. These risks are not totally reflected, which is also prone to systemic risk. And you know, systemic risk in general are non-linear. So it's when everything starts small and it gets amplified that it becomes systemic. So I don't see such a difference between climate risk as financial risk and other systemic risks. So couldn't we like account for this risk in capital buffers or in microprudential regulation, for example? Isn't that the right tool to do it? And do we really need the data to do it now?
Okay, well, thank you for the question. And before I respond to this, let me highlight something that Katrin started saying here today. I think it's very important to realize and for everybody to understand that the leading role in climate policy corresponds to elected governments. They should have the mandate for a consistent, coherent, and forward-looking climate policy. And it's for central bankers and within the realm of their mandate to have a supporting role. So I think this needs to be clarified and emphasized. I think it's good that Katrin started with this and I go back to this again, okay? Pricing CO2 is more effective than anything else that we can do on financial regulation. But let me also highlight, before going to the buffers and all these sophisticated tools, let me say that in my view, there are two very useful tools that we need in our toolbox that we don't have now. First is a taxonomy on environmentally harmful asset classification. Well, even the term brown is controversial, just to give you an idea. So the first thing we need is a brown taxonomy, okay? Second, that we need is a global and harmonized corporate sustainability accounting standards or reporting framework that is technically solid and garners widespread support, both from the private and the public sector. And in this regard, let me highlight that the International Financial Reporting Standards Foundation has recently launched a consultation to start with this work. And it will be definitely most needed to get the support from the G20 to their work, okay? I mentioned before that in my view, there are differences in the nature of climate risk compared to the typical financial risk. And I mentioned scenarios, and in my view, there is more room to use climate risk scenarios in financial assessment. And here I brought an example. Let's think, for example, of a scenario of orderly transition that is consistent with the increase of 2 centigrade temperature in line with the Paris Agreement, assuming immediate action, assuming that there are technologies available to remove CO2. In a world net zero emissions for 2050, if we look at the energy mix that it will be compatible with this objective, we see that the role of renewables grows substantially. But we also see a role for gas. And this makes me think about the following. if we follow some sort of economic approach, some sort of supporting factor for renewables, we need to be subject always to some sort of lower limit or binding restriction of meeting prudential requirements, so that capital will be there to cover any unexpected losses. For example, a change in technology, the withdrawal for some sort of subsidy for that sources of energy. The same could be said for any penalizing factor that could be thought on gas, for example. That should be also subject to some sort of upper limit or binding restriction, so that not pricing this type of activity off the market. Let me go back to the European Union, because they already thought about, the type of instruments that you mentioned. They are committed, as I said before, to revise all the financial regulatory framework. And it's important, the momentum and the sequencing, as I referred before. And in this regard, let me just bring to your attention some empirical work that has been done at the Bank of Spain, not on green and brown, but just on using risk weights as a mechanism to penalize certain credit to certain corporates, or supporting certain type of activities. And definitely there is empirical evidence that shows that some sort of penalizing factor will decrease the supply of credit of that particular bank and other banks that have not lent before, while the impact, the findings on the impact on the portfolio effect are less concluding. Same, any supporting factor will have a positive impact on the supply of credit to that particular corporate or activity or sector. And of course, also will be an incentive to lend more to that type of activity, to the extent that that regulation is perceived as permanent. As a reminder, and this I go to your initial question, there are two types of capital requirements. Some are bank specific, this is the micro-pru requirement, and other ones are system-wide or subset of the financial system. And these are nationally based, and these are the macro-prudential tools. Both use the same sort of micro tool, which is the capital requirement itself, that implies that there is some sort of risk weight difference between a green and a brown. In my view, calibrating capital is always a very difficult task. I always feel a lot of admiration for my colleagues that do calibrate every time the Basel Agreement is revised. But I think in the case of climate, in my view, this calibration is particularly difficult, because climate risks don't come every day, don't come twice a day. And think about that, so far, the capital framework envisages risk weights and probabilities of default with 1 year time horizon. And in that 1 year time horizon, climate risk may very well not materialize. So first issue is the calibration. And the second issue is whether it will be sufficient, because it doesn't happen very often. Will that capital be sufficient to cover any unexpected losses due to climate change? That to me also is quite a challenge. And now going back to your buffers and the macro-prudential tools, I think there is one of the buffers that is envisaged in the regulation that will be particularly apt to deal with climate risk, which is the systemic risk buffer, because this is meant to mitigate long-term, non-cyclical, systemic or macro-prudential risks that are not covered in the regulation. As I said before, this is aimed for the system-wide or the subset of the system and nationally based. Finance Watch has criticized this tool, saying that climate risk is global in nature. So this idea of a national based requirement seems not to bode well with climate risk. At the same time, it could be argued that, for example, climate physical risk are regional or local in nature. So this will be very well adjusted to that. And of course, it very well happen that there are certain sectors or economic activities in which those sectors are important, that are particularly relevant in certain countries, and that get financing for from banks in this country. So definitely there is room for that. And as I said before, I think in the realm of prudential regulation, the European Union has already given the mandate. So in the next 2 years, we will have a comprehensive analysis of what is the tool that is best adjusted to deal with climate change. But I think at this stage, we all need to recognize that climate change is very different from the typical risks that we are used to deal with. Thank you.
Maria. Thank you, Maria. You just mentioned that in the case of regulation, the climate change is much more in line with the mandate, or there is much less debate on the mandate than for monetary policy. Let me come back on that, and then ask also maybe a technical question to you, Katrin. So you, I mean, the debate of the mandate under the mandate is at the core of all debate, since we speak about climate change and monetary policy. And we had last week a very, I think, powerful piece by Frank Elderson, the new member of the executive board of the ECB, saying that, of course, there is a secondary mandate, and this secondary mandate is not an option for the ECB; it's a duty. So the sovereign must do something for fighting climate change, as long as it doesn't impair its primary mandate. And there are several propositions that suggest to use tools that central banks are using now, like for example, targeted refinancing operation, to do some things for fighting climate change. And I was wondering whether you can use these tools as long as basically you can still transmit your monetary policy and still have an impact on inflation. So maybe you can calibrate these tools by, for example, realigning a bit targeted refinancing operation without impairing your global transmission of monetary policy. So what is your view about this conflict, and also this potential to work on both sides at the same time by calibrating what the central bank is doing? Do you have a view on that, or you want to reborn on something else that Maya and Emanuel said?
Thank you, Pierre. Now, I must say, I agree with a lot of what has been said before by Maria and by Emanuel. And things that particularly resonated with me is first what Maria said, that climate risk is different. So it's highly uncertain, it's long-term. And also Emanuel said there is more analytical work needed. And so now what you are mentioning, of course, when you talk about climate risk and monetary policy, you think typically of the operational side. And I think Emanuel has already mentioned a number of measures that have been taken to make green bonds eligible, to adjust the collateral framework, and all these on the operational side. And I think there is quite a lot of agreement that we shouldn't structure our operations in a way that we hinder climate change objectives when we implement monetary policy. I will come later to the question of active pursuing monetary policy. But if you think about climate change and monetary policy making, this goes much deeper than what you are thinking. So first thing, what we need to do is we need to have analytical models that help us forecasting the economy facing climate change. So now you may think, well, climate change is kind of a long-term trend, and who is interested in that? But if you think more closely, then we had extreme weather events. We had droughts, for example, that pushed up the price of food. So of course, this is reflected in CPI, but you can also think about, well, it's probably something that also impacts kind of inequality, because if the price of wheat is moving up because of droughts, this could have implications that are not adequately reflected there. We had, for example, also very low water in the Rhine, I think 1 or 2 years ago, which disrupted transportation chains in Europe. So these are all things that are already there and that we need to take into account when we are setting monetary policy. Second thing, what we need to reflect in our modeling is mitigation policies. So the German government is hiking up carbon taxes. So this will have an impact on inflation. This is something we need to take into account. We have to think about first and second round effects. We have to think about supply and demand effects and how to disentangle those. Think about, as an example, the COVID experience. So we are discussing big time what is the impact on demand and what's the impact on supply, and how this will match and how this will affect the dynamics of inflation. So these things will become much more prominent. And these things are first order things for a central bank. So we need to be prepared. We need to have to think about how we set our monetary policy in response to these effects that are already there. So that's not kind of a long-term trend that will hit in 2050 or something like that. These are things that we need to take into account when we are discussing monetary policy, when we are discussing the appropriate response to these events. Then, of course, we have these lower impact things, these long-term things, which also can affect the monetary policy space. So the discussion of the equilibrium rate of interest, R star, is very prominent. People are not, don't agree whether climate change will lead to a lower R star, meaning that we are more frequently at the lower bound and that we will need to implement non-standard measures more often, or whether the structural change that is required by climate change, and which Emanuel mentioned, would require more investment and in the end bring a higher R star, which would mean that we can rely more on traditional interest rate policies to steer the cycle and don't have to resort as much to asset purchases. So, and there, of course, the question is, should we tilt our operations towards asset purchases? And I'm now not talking about the legal impediments. I have talked about that before, but just very practical. At the moment, as Maria explained very clearly, we don't have a taxonomy. We don't have kind of a yardstick that is there and that can tell us what is green, what is not green. So if we want to deviate from market neutrality and if we want to go towards something that's more green, we would have to have something that we can rely on. The second issue is that the markets at the moment are relatively small. So we are purchasing market neutral. So we are holding the market share of the green bonds, but currently, I think it's about 3% or something like that. So it's not like that this is a market that can help the ECB to achieve its price stability objectives. So it's not, at the moment, it's not enough. You can say, well, if we go there, we probably can make issuers issuing more green bonds. But at the moment, it's not a question of demand. It's more a question of supply and a question of pinning down what a green bond is and what it's not a green bond. So there are many investors around that would like to purchase green bonds if they know for sure what it is. And finally, I would expect that monetary policy over the cycle should be neutral. So if we go towards green bonds with a view to lowering financing conditions for environmental friendly projects, at some point when we want to tighten monetary policy, we would have to sell them. So in the end, if you think that balance sheet, central bank's balance sheet, go back to something that's more normal, this would also mean that we hike financing conditions for environmental projects. So over the cycle, it shouldn't be a big impact from central bank purchases on financing conditions for green projects. That's why I believe that in the end, it's for governments to go there, and it's not for central banks. Of course, we need to be mindful, we need to set the environment, and we need to have instruments that don't hinder climate change, but are supportive for the climate change. But I don't think that the central bank is in a position to do a very effective, active policy to pursue climate change targets. So I think I'll stop there.
Thank you very much. I will use my prerogative as presenters just to make a clarification, because this is I think a confusion that came several times in these seminars, and I would like to be clear. often like a green monetary policy is associated with buying more green bonds. So that's the first reaction for everybody you talk to. And I think by sustainable monetary policy, we don't mean buying more green bonds. There are several sustainable economic activities that are not labeled green. So I think we should stop focusing on a green bond market, which is anyway way too small to transmit monetary policy, and think about more generally. And I think we should take the other way around, and I'm coming to you, Emanuel, with that. It's not trying to buy more green, but maybe buying less of brown, or not brown, but polluting activities, because we know that these are the coal, for example. We know it's risky. We know it's an activity that should disappear soon. So having coal assets is a risk per se, and it's much more easy to identify what is not aligned with the transition than what will become the transition. So that's a big an introduction for our next question, Emanuel. You say that there will be winners and losers in the transition, and I mean the losers and that market are not really pricing these risks. So basically, if you all losers in your portfolio, you're exposed to risk, and if you have them in the same scale as the market, and the market is not pricing these risks, then you might be more exposed to transition risk than what you would like. A good monetary policy is also to have super safe assets on your collateral or in your purchase. So wouldn't you? Is there not a need to reflect that in the collateral, this risk in the collateral framework? I think you say yes. My question is more about the timeline. So we know these risks are there. We kind of already know which are the assets the most exposed. Coal is one, of course, is one. What more is needed now to act on these kind of already empirical evidence? What would you need to concretely be able to implement something like that? Or do you have an answer for that, or do you want to also react to other comments by the others?
Thank you, Pierre. So let me first answer your question, and then also reflect on a few things that have been said. So with regards to your specific question, I do think that we need to take into account the risks emanating from transition and climate into that we have on our balance sheets, and that to protect the independence of monetary policy, it's really vital to make sure that we don't take on risks that we don't understand, and that pose that can materialize in the horizons we care about. And so I think it's key that we understand these risks and then think about ways to mitigating the risks we assume on our balance sheets. But there's a lot we don't know yet. And you mentioned coal, but many energy producers also engage in activities that support alternative non-carbon projects, etc. So it's very difficult, I think, in practice to really pinpoint, and that comes back to the taxonomy that both Maria and Katrin alluded to pinpoint to what is brown and only brown, and what is green investments. So that said, I think we do need to improve our understanding of these risks. We do need to make sure that we disclose these risks and what we understand about them at an ambitious timeline. I think the initiatives regarding the non-monetary policy portfolios are very important in this respect, and we should try to be as ambitious as possible, but also as careful as possible in doing similar, following a similar route for the monetary policy portfolios. And there's a lot of practical questions that emerge that I think we need to answer very carefully. And we have to be very adamant not to pursue industrial policies. I think it's one thing to understand these risks and then take them into account into monetary policy operations, but to exclude certain industries without really being able to translate that into financial risks that we may take on our balance sheet is very close to industrial policy. And I think to guard and safeguard our independence, we have to stay away from such policies. So I think it's very important that we follow a risk-based approach to understanding and incorporating climate change related risks without jumping too quick on conclusions that may lead us into a territory that's closer to industrial policy and where the independence of the central bank is at risk. With regard to the things that have been said, I agree with a lot of things. I would like to say that I think as a Eurosystem with the particular mandate that we have, I think it's a very intricate discussion, and the secondary mandate has not really been applied in the past and to support specific economic policies of the European Union. And I think it's a fine line that we need to walk, and I think many policymakers are very skeptical whether we should refer to the secondary mandate in our actions related to climate change. And I tend to agree with those skeptics, because I think it's very hard to prioritize among different policies, even though we all agree that climate change is of first order. But the political pressure to also then incorporate other economic policies into central bank actions will be large, and so I think we have to be very careful in walking down that path. And so I think a risk-based approach is the right one. The one thing also, one comment on the efficacy of these different types of policies. I personally think that the leverage we can get from raising disclosure requirements and contributing to the production of climate-based information on climate risks in the marketplace by enhancing disclosure requirements is quite important. And compared to some of the other proposals that have been discussed, adjusting asset purchase programs, etc., I think the bang for the buck you're not likely to get with those policies, but much more based on the improvement of the disclosure requirements and making sure that the information on climate risks is being produced in the marketplace. And then, of course, I also agree with Katrin in that elected governments have the most appropriate tools in addressing climate change by using carbon taxes and trading schemes. So that is also, I think, important to keep in mind and reiterate as central bankers that while we do have tools, the most effective tools lie within the hands of elected governments, and that is important to understand and communicate as central banks.
Thank you very much. So for the audience, the floor is open. If you have some questions, please put them in the Q&A section. There is already one, which I think summarize one of the key point that you all three been approaching. So basically, I agree with you, Emanuel, that disclosure is a prerequisite. It will help everyone to have more data. More data on climate is always good. That's fine. But disclosure per se is not enough. I mean, people have to act on this data. And probably one of the problems now with financial market is that the financial investors are not using all the data available on climate to make the decision. And that's why climate change is mispriced. So one question related to that from the audience is, to what extent climate change indicators that we have now are accurate and up to date to enable central banks to act on these? So, and either central banks, or also we can think of the banking system of banks. What do they need? And if they're not enough accurate, what would be the milestone to reach, or the level of data or preciseness to reach to start acting on that? What is missing now? And you can I'll let you reply who wants. You can also react to what has been said before. Do someone wants to react on that?
If I may,
Yeah, sure.
Yeah, because I went through this already. So I'm going to make the work for Emanuel and Katrin easier because I already highlighted. Probably some of our audience comes from the United States, so they are not updated of what has been done in the European Union. And just to remind everybody that in the European Union, we have already agreed on a taxonomy for green, okay? So we already have a taxonomy for green that should meet certain objectives in terms of substantially contribute to climate change mitigation, to climate change adaptation. There are 6 objectives. And these activities have to contribute to at least one of them and do not harm all the rest. So we already have something that it will give us a good idea of what is green, and it's very important that it's not sectoral. It doesn't use the NACE code or the ISIC codes, that is what traditionally we are used to, but looks at the corporates and looks at each of the activities. So a corporate can have activities, it could be activities that are green and activities that are less green, so to speak. What we are missing, and I mentioned that before, is conspicuously missing a taxonomy of brown. As a matter of fact, not even the term brown is politically correct. We should refer to environmentally harmful assets. Okay, so we are missing that. And then since everything, for example, for the purpose of climate risk is based on those harmful activities, we are missing an important leg in our analysis. And also for everything that has to do, particularly with financial institutions, is an accounting framework. An accounting framework for sustainability. And I mentioned before that the International Financial Reporting Standard Foundation has recently launched a consultation, and that the G20 would work on this, and to have the support of private initiatives and the public sector in this will be paramount. We already have a number of private initiatives like the Task Force for Climate Disclosure, that it was also sponsored by the Financial Stability Board, by the G20, but we don't have a comprehensive, technically solid reporting framework. And we are starting to consider that this is necessary, and I know well that work will be done in this regard. So I think that these both pieces will help definitely a lot on better understanding climate risk for financial institutions.
Thank you. Does anyone wants to react on that? If not,
I think these ingredients are key, and it's really to operationalize what climate risks mean in terms of financial risks that financial intermediaries, but also central banks take on their balance sheets. I think is a key question to be answered, and I think this is really an area where we need more analysis. I agree with the urgency to act, and I agree that we need to do this carefully. So I think we need a lot of analysis very quickly on this important topic, and clearly the Eurosystem and other institutions need to put a lot of resources behind this type of analysis.
Yeah, of course, I agree, and the Eurosystem is also helping in shaping these work and advising on this work. But if I can come back to monetary policy, I think, well, central banks are following. So I think since it's based on the secondary objective, central banks by construction are following the discussion and the developments that take place in the society, in the political discussion. And of course, they support and they bring their expertise into this process, and they also adapt to the consensus that has been formed in these areas. But they are certainly not the ones that set the climate change policies. So this has to be done by governments. But this is not to say that central banks will never apply green purchases or green LTROs or whatever there is possible to do. But what I'm saying is just the central bank is not at the forefront of this development. So it's bound by its mandate, and it's in a supportive role to governments. So if governments and regulators don't do their work, it's not up to the central bank to step in and say, but we move ahead and we show you how it goes. So I think that's a fine line, but I think this distinction is important.
There's one question that maybe that relates to exactly making the job of the ECB easier in terms of choosing. If I understand the question well, which is quite long, is that the Parliament could put some limits or some requirements on how to use the ECB instrument more legally. And if that is the case, would that help you? I mean, when I talk with some of the colleagues, my ex-colleague here in Switzerland, they, for example, on coal, they agree that it's a risky bet, or it's a risky asset to have, but they also, like you say, it's not our task to decide that. But they say, if the Parliament asks us to do that, we will do it, because then it's going to be your mandate. So would a change or precision of your mandate kind of help you in that, or would it also be something not useful?
Well, so first, let me say there is a lot of research around that shows that if you give the central bank a dual mandate, then a central bank has to do a trade-off that is probably better done in the political sphere. So no matter what this dual mandate is, be it employment or be it environmental sustainability or whatever. So just from a very abstract reasoning, the central bank is a non-elected body. You have one instrument. If you have two targets, the decision which target to pursue to which degree is taken by non-elected bureaucrats. And I think it's a societal question if you want to do that or not. So I'm not saying it's good or not good, but you delegate this trade-off to an institution that's not elected, just to say that. And I think there is general agreement that a central bank with the interest rate is better in pursuing price stability than in pursuing climate change policies. So, but if the European Union wants to give a climate change target to the ECB, they can do that, yes. If they link climate change targets to the instrument, I think it's more difficult because instruments currently are already quite stretched, so policy space is not that large. The more restrictions you put on the instruments, saying that you can only purchase specific assets or you can only accept specific collateral, the more you also restrict the ability of the central bank to do its price stability, to pursue its price stability target. So also there is a trade-off. Of course, we have trade-offs that we manage, as Emanuel already explained. To a big extent, we have to manage the risk on the asset on the balance sheet. And of course, we take into account climate-related risks. We are also the regulator. Maria talked about that. So I'm staying away from that because that's not my area of expertise. But there are, of course, areas where the ECB and the Eurosystem are very active and they are relevant for climate change. But if you look really at the mandate and the monetary policy, I'm not sure whether it's such a good idea to give a climate change mandate to a central bank.
Hi, Emanuel, you want to respond on that?
Nothing
No, I mean, Maria, go first, please.
no, nothing to add on my side. Thank you.
Okay, same here. I mean, as I already said earlier, I'm skeptical of referring to the secondary objective in addressing climate change. I think there's a lot of reasons for us to incorporate climate change into our monetary policy frameworks already based on the price stability objective. We do have to understand better how climate and transition risk affect price stability. And we do have to safeguard our balance sheets. So a risk-based approach, I think, will lead us to consider a lot of potential actions regarding climate change along the lines of what we've discussed, going down the route of soliciting the making reference to the secondary objective. I think is at least a dangerous line that can lead to all kinds of potential time inconsistencies that you need to at least be aware of. And I think that's an important discussion the policymakers are having right now. And I think it's a very difficult discussion. But I think even on the basis of just incorporating climate change related risks into our framework, I think there's a lot of potential things we need to understand, analyze, but then also can act on in our policies.
So sticking to the primary mandate, and I will come back to you, Maria, after, but maybe this one is for the two monetary policy economists. So do we already have evidence that climate change has an impact on prices? And if not, what do you think will be the impact, and how would that how should that be taken into account by central banks? I'm asking that because there is much more research on financial stability in general than on what would be the impact of climate change on prices. And that's important for central banks to know. So where do you see links there?
So, I mean, it's true that there is relatively little evidence on the impact of physical climate risks and transition risks on prices. There is some evidence that suggests that climate change related natural disasters have an effect on prices. It's relatively small effects and not very persistent. But then we all, I think, agree, or many of us agree, that both the persistence, the size, and the frequency of climate-related shocks will increase in the future. So I think with that in mind, it's reasonable to assume that climate change will have quite a bit stronger effect on prices in the future than it has had to date. And so I think this is something that why we need to understand better what exactly these effects will be. But given historical data, it's also difficult to assess. But I think we agree that there is a clear link between physical risks and then, of course, transition risks as well. The effects that have been measured with historical data are relatively moderate, but the size, the frequency, and the persistence of these shocks will change in the future. So I think we can expect these effects to be larger in the future. To what extent they affect prices in general or relative prices, I think is also a question that we need to understand better. And here we again need more research and analysis. But clearly many prices will be affected by natural disasters and by the transition towards a low carbon economy. So clearly as a central bank, we need to be wary of these structural changes and understand better these effects.
I gave you a few anecdotal examples from the recent past. So they are not related to natural disasters. And I think you probably think too big if you think of the big natural disasters as now will blow up the calculation of the HICP. I think you will see a lot of small things that are somehow related to climate change, be it low water levels. We had in Switzerland, I recall there were damages on highways because of the heat. So these things will increase in frequency. And of course, they will impact our ability to forecast prices and to forecast the economy. So in that way, it probably will increase the volatility of inflation and less so the trend. So I would still think in very old-fashioned monetary separability that you, as a central bank, you can set trend inflation, and you probably will have more volatility in prices and relative prices. And this is exactly what Maria said. So climate change risk is very hard to forecast. So you know that something will happen, you will have an extreme weather event, and at that point, you get a spike in inflation or a drop in inflation. And you also get difficulties in measurement of inflation. So I mentioned COVID. In the COVID part, we had goods that were available, but that we couldn't buy. Think of travel, think of leisure activities. So you have an inflation measure that is completely unrepresentative of what people actually consume. And you can imagine easily that with climate change, similar occurrences can happen. So you can have kind of a extreme weather events and people get just stuck in the area, and the economic data that we are having are not reflective of what's actually going on in the economy. And I think we need to step up our analytical capabilities for that quite a lot. And this is something that's maybe not as catchy as doing green operations, but it's something that is in the core of central banking, and it's something that a central bank definitely has to do. So we have to know much more about how the economy works in the face of climate change, and this probably will also give us more evidence about what we can do to mitigate the climate change and emissions.
There's one, I think, I don't know if it's a consensus, but at least it's something that is often said in the debate around central bank, is that by kind of replicating the market, the central bank is also reinforcing the lock-in, the carbon lock-in of financial markets. We know that now that financial markets are not aligned, and that by replicating you kind of support this lock-in. And maybe it's too far stretched, but we know that for financial stability, it's better to have a transition. That's the best option between no transition, too late to sudden transition, and an orderly transition. And you just highlighted that, you know, physical risks have a lot of impact on price as well, and are likely to have much more impact in the future. So in a sense, for the central bank, the best way is a smooth and early transition, both for financial stability mandate and for price stability mandate. So yeah, and by following the markets, you don't trigger the transition, or you kind of support the lock-in. So doesn't that go against both financial stability mandate and price stability mandate in a sense?
Well, there is this requirement of market neutrality. And I think that links exactly up with what Emanuel has been saying. The central bank shouldn't pursue industry policy. So if we shouldn't say, well, we are purchasing no car manufacturers, or we don't purchase coal mines or whatever. But it doesn't mean that we only purchase the market. So if we have evidence that prices are not aligned with the risks that we are taking on the balance sheet, then of course we can deviate from market neutrality. And it's also what the central bank is doing, because we require good quality. We are not buying high yield and so on. So if there is something that is reasonably well established, the central bank can deviate from market neutrality. And if there is agreement that there are, as Maria said, that there are certain assets that are harmful for the environment, and this is established, then of course the central bank can say, we don't accept these assets because we think that the risk related to this asset is too high. So I think at the moment, a lot of things are still on the move. It's probably too early to to have definitive answers, but of course the discussion has started, and of course central banks will monitor this discussion and will draw their conclusions from the ongoing consensus that is emerging and from the work that is being done in this area.
Maybe Maria on the link between, you know, the need. I think the need to, for financial stability reason, I think the best option is a smooth and early transition. So,
well, of course, we all would like to have a smooth and orderly transition. But again, I mean, if you look at the scenario analysis that we are doing at the Network for Greening the Financial System, and by the way, the International Panel for Climate Change, United Nations, done the same exercise. I mean, all of this depends, as I said before, these scenarios depend on the policy ambition to reach certain temperature targets and the existence of technology. So at this moment, if the prices are not internalizing the true climate risk, it means that either policy ambition is not too ambitious, or that our technologies available are very limited, or a combination of both in this very bidimensional analysis that we do, you know, for climate scenarios. Again, I think definitely I cannot agree more with Emanuel and Katrin on the analytical capabilities. And let me be a little bit more bold to say that we need to change some of our framework of thinking that not necessarily adjust well to climate risk. Again, because as central bankers, our objectives are short, medium term. They are not long term. And I often find myself, you know, talking to colleagues in other central banks or in my own central bank, say, well, this tool is perfect for the traditional credit risk for which we have a lot of observations for the past. But this tool is not going to be good for climate change, and we need to adjust. And I think this is our contribution. This is the contribution of central banks. We central bankers cannot change the price of CO2. We cannot set policy objectives of net zero that are more ambitious than 2050. But we can be more flexible in our analysis. We can open our minds to different tools of analysis to think about climate change.
thank you very much. So that sounds like a conclusion for you. We're slowly coming to the end of the seminar. If you would like to have a last word, if you forgot to say something, or you want to react or have a few words of conclusion, I think that's the time. Emanuel, Katrin, or Maria.
So what Maria said resonates very much with me, I must say. So we have to think about climate change and how we can contribute to that. And I am sure that there are many angles through which we can contribute, and we are already contributing. And many of them probably don't look as great or as revolutionary as people would hope and think. But I think the sum of all these small measures will also make a big step. And in the end, it's about sustainability, not just sustainability for the environment, but also sustainability of the measures and sustainability of the change in thinking. And I think it's important to be careful and to move in a sustainable manner to also achieve these objectives, and not to have kind of a fad or fashion that in the end lasts for a few years and then goes away. So this is kind of a long-term challenge, and if we take small steps, of course, we need to be quick and we need to push down carbon emissions very quickly, but that's not the tools with the tools. It's not possible with the tools the central bank can have. So we are more for this sustained change in thinking, and I hope that I'm convinced that this will also contribute to that objective.
And then let me just chime in by agreeing with Katrin and Maria on exactly this issue. I think, given where we're coming from, that basically climate change up until 2 years ago has not been any discussion in central banking circles, or very little. I think we've already made a lot of progress. We shouldn't, of course, stop there. And many of the issues we discussed today are being discussed in the Eurosystem right now. And I think actions will be taken that take climate change into consideration in the new framework. Whether these actions are as ambitious as maybe some out there hope, I don't know. But clearly, the ECB, the Eurosystem, will be one of the central banks that will have taken climate change into account in its new framework in one way or the other. And so I think this is something that we should all also highlight, that basically maybe we're behind the curve, but we're catching up, and we're doing something. But we should keep iterating that the most effective tools to combat climate change lie within the hands of elected governments, and we should keep the pressure high on these governments to actually do something, and then we'll do our supportive role as much as we can.
Thank you very much. So let us end with these words. That, I mean, I agree that a lot of policies, efficient policies, lies in the hand of the government. I also think that a carbon price solves everything perfectly only in textbooks, and that in reality you need a coordination of all policies to go in one direction. And as Katrin is saying, also the accumulation of small policies. And I'm relatively convinced that central bank can do more as a small step to also align with that. Thank you very much for this very interesting seminar. I hope I did not ask too many questions that were uncomfortable, as I promised. And let me just finish by reminding the audience that we will have another webinar on the 8th of March, which will not be a panel, but a traditional seminar where Francesco Giovanardi will present his working paper on preferential treatment of green bonds. Sorry. Let me also remind you that you can continue the discussion on the Slack page of EAXIS Forum. And with that, have a good evening and see you in 2 weeks. Thank you very much.
Good evening, and thank you. Thank you so much.
Thank you so much. Good evening.